I just saw this TikTok on from Tim O'Leary from the Shark Tank, and he was talking about generation skipping trust, and how he prefaced that is that his mom paid for everything until he graduated college. His mom then says, "That's the last check that you're gonna get. You're done." So whenever 21, 22, and he said, "Mom, I don't have a job right now. I'm gonna go bankrupt right when I get out of school. Figure it out." So he said that ended up one of the things he gives respect to his mom for helping him to become, millionaire, billionaire when they sold that company that he had at a very early age. So he said that, now that he got more involved with trust and that one was set up for him, one was set up for his kids, he started talking about that for grandkids. So, Dan, do you have any thoughts about people who want to set up a generation skipping trust? How does that work? What is it for? What have you kind of seen it used in what context?
Oh, absolutely, Chris. So we've done a lot of generation skipping trusts, and sometimes they're called Dynasty Trusts or a GST trust. So those are generally the names that you'll hear one referred to. GST, which means Generation Skipping Transfer, or Generation Skipping Trust, or Dynasty Trust. Basically, that's any trust that skips a generation. So it's going from a parent skipping the child and going to the grandchild, or from the grandparent skipping the child and going to the grandchild, or from a parent or from a child going through their skipping over their children to their grandchildren. And basically people do that to avoid estate tax. I mean, that's the major reason, because if you leave your whole estate to your kids and you pay the death tax when you die, and it's due in cash within 9 months, the estate tax, then when the children die, just the next generation, so that's like another 25, 21, 25 years, then the children are gone, there's another death tax. And so the death tax, the estate tax, is hitting every single generation. And the estate tax is 40%. So it's a massive tax to have to pay every 25 years. So sometimes it's about control, like you said, the mom or the grandma saying, "That's your last check, Sonny. You got to go out and make it on your own now."
Right.
Sometimes it's about control, but more often it's about avoiding taxes. So the idea is, put the money, create a trust, a dynasty or a generation skipping trust, and allow the child to have access, and they can have income, they can have health, education, maintenance, and principal withdrawal rights over the principal, but they're not technically the owner of the trust. So when the child dies, there's no estate tax in the child's estate, because the child isn't the owner for tax purposes. They just have the right to income, for example. When the child dies, the principal will actually skip them and go to the grandchildren. So it avoids one whole generation of estate tax.
Wow.
Which, if you're talking, many millions of dollars, 40% of millions is a lot.
Yeah.
And that's the biggest reason why people do a generation skip, is to avoid that 40% tax. The other reason, as you said, is maybe the children don't deserve it. Maybe the children, maybe the parents want to incentivize the children to work harder. Hey, if my kid knows he's going to get millions, he's going to stop trying. He's not going to go to school.
Right.
He's not going to excel in anything. So I'm not going to give it to my child. I'd rather leave it to the grandkids. And we see a lot of that too. And in America, you can do what you want with your legacy. You can leave it to your spouse or not. You can leave it to your children or not. You can skip a generation and leave it to grandchildren or not. That's one of the privileges we have here.
So Dan, what happens? Like, I know there's some changes coming to the estate tax. I forget which one, but let's just say in general, not only that one, but what if they change over the generations and they actually? I'm guessing they're probably going to be increasing, I'm sure. Do you have any thoughts around that, like being subject to tax, or is it still a great way to kind of avoid things still? Or what are your thoughts on that if tax laws are changing?
Well, I think it's safe to say you're right, and tax laws are always changing. Every time there's a new state legislature, tax laws can change. Every time there's a new Congress, and during any seated Congress, tax laws can and do change. So right now, the federal estate tax only applies to assets that are in excess of $12,920,000. That's the estate tax exemption and the generation skipping exemption. And anything over that gets hit with the 40% tax. But that is changing on December 31st, 2025. That $12,920,000 exemption drops back to $5 million plus inflation. Now, for a lot of people, $5 million is going to be plenty. And remember, it's $5 million for the husband and the wife. If you're married, that's 10. And if it's adjusted for inflation, at this point, it's probably going to be close to $6 million. So each husband and each wife in a married couple, 6 plus 6 is $12 million. So that change is coming up unless Congress moves to terminate that sunset provision and make the 12.9 permanent. And they could do that at any point in time, all the way up until December 31st, 2025.
Wow.
So we'll have to see what happens there. And the bottom line is nobody has a crystal ball, at least not that I know of, and so nobody knows what's going to happen. But the current law is the sunset provision sunsets the $12,920,000 exemption on 12/31/25. And that's what you have to base your estate planning on, is the current law. You cannot base your estate planning on conjecture or hope or even what a committee is necessarily talking about until it becomes law.
So let's say, Dan, that we already have the living trust. For those people who already have them, I have a living trust or I want to get it set up. What if they want to add two things? It's a double-fold question. What if they want to add this now GST, generation skipping trust, or they hear about this tax law that's coming up in 2 years? Do they give somebody like yourself a call? What do they do to kind of prepare for this change? Like, hey, I want to add this, or that something's coming up legally and I should probably talk to my accountant or talk to my estate planning attorney.
Yeah, well, in fact, a lot of people are calling us right now, and they're giving away their $12,920,000 to their children or grandchildren right now while they can, to grandfather it in before the law drops it back to $5 million. So
they're on it.
That's exactly they're on it, and they're making gifts in advance while the exemption is still high. And so that's something that, there are pros and cons to doing that. The advantage is, well, I just locked in my $12,920,000 gift exemption, so that's good. The con is now you don't have $12,920,000, right? Now you're out $12 million, and your children or grandchildren have control. So you have to be able to afford to. You have to be comfortable giving away what you're giving away and no longer having control over it. Once you make a completed gift to children or grandchildren, you have generally you don't have any control over it. And if you had control, it would be a taxable incident of ownership. So that's what some people are doing. Another thing is, as you mentioned, you might already have a living trust. So a GST, a generation skipping trust, doesn't have to be a whole new trust. It can be a provision underneath or part of your current living trust. So, for example, you can say, I want to leave half my estate to my children. Mm-hmm. You're not skipping a generation. And I want to leave the other half equally to all of my grandchildren, present and future grandchildren. So you get, essentially, by amending your living trust, you've added a dynasty or generation skip provision to the existing trust that takes effect when you're gone. So it is possible to take your existing living trust and add a GST provision. In fact, any distribution to grandchildren is essentially a generation skip.
Yeah.
Or alternatively, a dynasty or generation skipping trust can be a totally separate trust. It could be an irrevocable trust with its own federal tax ID number. So you end up with a living trust and an irrevocable generation skipping trust into which you've gifted the maximum generation skipping exemption amount. So you could have two trusts. A lot of ways to do it. In fact, I think the key is, if you've got some children you want to skip for whatever reason, if you're trying to save estate taxes and so you want to do a GST, so when your children are gone, there's no estate tax on that part of the estate. For any of those are all good reasons to really research and discuss making a GST trust with your attorney and your accountant.
Yeah, and you just led into the question: what would be the benefit of doing the foundation versus this generational skipping trust? And having the control, it's kind of interesting where you were kind of going with it. Is there advantages or disadvantages of that versus a foundation for somebody, like setting up a foundation versus a general GST?
Sure. I mean, when you think of Dynasty, the idea is leaving a legacy to last as long as possible, right? So, but the problem with the Dynasty inside a regular trust is that it's still subject to estate tax when the grandchildren die. So at some point it's going to be taxed. And it could be 40% going to the federal government, right? So a way to create essentially a dynasty or a legacy with zero tax, it's not a regular generation skipping trust. It's a private tax-exempt 501c3 family foundation. And if you leave part of your estate through a regular living trust to the tax-free family foundation. Now, think Bill and Melinda Gates Foundation, Tiger Woods Foundation, Rockefeller Foundation, Ford Foundation, Carnegie Foundation, right? These are the large foundations. Most foundations are pretty small, under $1 million. But that, in a sense, creates a dynasty because the children, the grandchildren, the great-grandchildren, for perpetuity can work for this, let's call it a multi-generational but charitable trust. They can draw reasonable salaries from the foundation. And they can engage in philanthropy that will benefit their community, their country, the world. It can do all kinds of really cool stuff. They can help children or medicine or athletes or animals or even scientific research. Anything that makes the world a better place can generally be a charitable purpose for one of these organizations. But so I guess what I'm saying is there are limits to what a standard generation skipping trust can do. Mm-hmm. And the limit is still the maximum exclusion amount. Mm-hmm. And that'll be $5 million in a few years, right? And that's the limit for a dynasty or GST trust. But if the estate's larger than that, they can shift gears and go into a family foundation, and there is no limit. You literally can be Warren Buffett and put $40 billion into your foundation, and there's no estate tax. Wow. And the family can use that to create, I don't know if dynasty is the right word, but because it's really it's a charitable organization that's supposed to benefit the community, but it's still going to have great benefits for the family. It's going to keep the family unified with a purpose, with the idea of philanthropy, with an idea of remembering where the wealth came from, who created it, and having it used not only to edify the family, but to achieve a lot of charitable objectives.
So Dan, let's just say somebody is, from a tax situation is under those limits. They don't need to set up this foundation, nonprofit foundation trust. What if somebody's like, you know what, they have so much money and they're not paying taxes and they're abusing it because now their kids can get a salary or this? Is there any provisions around that, or can it get so abused? Is it really abuse, or is it really like a good thing because they're helping communities? And so do you have any thoughts around just somebody who may not be in that situation? Like, what are your thoughts about?
Well, there are rules. I mean, a private foundation has to file a tax return each year, and salaries have to be reasonable. And if there is abuse, it's going to be subject to an excise tax, or the foundation could lose its tax-exempt status.
Oh, okay.
Right. So it's not a free-for-all. There are very definite rules about what a foundation can and cannot do. It cannot be used for politics to get your buddy elected as congressman or president. It can't be used for risky business adventures and that kind of thing. So, there are rules that pretty much define how a foundation has to operate to make sure that the benefits enjoyed by the family are within proper parameters and are reasonable. And, I mean, a foundation has to spend 5% a year terms of fulfilling its charitable purposes.
Mm.
And the salaries have to be just a small part of that. It can't go over that.
So it's regulated to a degree, and
definitely.
it sounds like most of these foundations, at least that I've heard of, I mean, maybe some of the big ones, they are advancing a lot of community projects or a type of, forgive me if I'm misinterpreting this, but kind of like a fundraising type thing, or like, there's not a lot of people who just focus on maybe Alzheimer's disease. So can a foundation be set up for something in support of, particular health or research type things like Bill and Melinda Gates, or could it even be religious, I guess, just kind of going off a little bit on a tangent with the generations doing something for this purpose?
So all private foundations have to have a charitable purpose. And yes, they can give money to any other foundation or any other already pre-approved tax-exempt organization, or they can have their own charitable purpose, such as trying to cure pancreatic cancer, for example, trying to find a cure for cancer or Alzheimer's. And as long as that purpose is mentioned in the document and approved by the IRS when it gets its approval, then they can have special spending privileges with regard to that particular charitable purpose. And that, as you say, could be the legacy that the family wealth is used for over time and remembered for.
I mean, so arguably you hear a lot of people like, well, I mean, it doesn't even matter like what income bracket you're in. Like, I don't want to give my money to the government. So in essence, it's kind of being used for giving back to some great causes.
Well,
is that an accurate statement, or what are your thoughts?
Well, yeah, I think so. I mean, a lot of foundations are self-funded. That means the money comes from the person that created them. They don't need anybody else's money. They made their money themselves. The money goes into their own foundation. But a person doesn't have to be wealthy to have a foundation. They just have to have a vision and a charitable purpose. It could be anybody with very little net worth, and they could form a foundation to help cure and treat mental illness, for example. And then other people can donate money to their foundation.
Oh, interesting.
So they can have fundraisers and contests and golf tournaments.
That's great.
And bowling tournaments and gala dinners where everybody shows up, and it's $200 or $2,000 a seat, and they're raising money. Even though they don't have their own money, they're raising money to help find a cure for mental illness. So you don't have to have Voku bucks to create a foundation. You just have to have a charitable vision.
And well, it's kind of like a trust. A lot of people thought, funding the trust and setting up a living trust is for
the wealthy only.
Yeah, it's the wealthy only,
and
right? So it's a misconception.
Yeah.
Okay.
A trust is for anybody that wants to avoid probate and have something in place just in case they, become incapacitated or heaven forbid, pass away. So, all good stuff.